Hello everyone. We have launched our educational series for those who are looking to invest in real estate space or to build career in real estate. So for today's session, we are going to review Embassy REIT, and the bottom line of our discussion would be, should we buy it or shall we wait a little? Passion for real estate has never been changed in our civilization. Everyone's desires to have at least one real estate property was always there. Since real estate is a scarce commodity, the never-ending desire to own a real estate leads to the property appreciation or the price appreciation of it. This is one of the major reasons to own a real estate asset, apart from obviously getting a shelter from it. Everyone wants to make money. Real estate has always been one of the major platforms in terms of investment, especially for middle class families. However, owning a real estate property nowadays has become a costly expense, due to which many who desires to own a real estate property does not get chance to invest into it due to huge capital requirement. REIT on other hand has become an alternate to this problem. Real Estate Investment Trust REIT is a company that owns, operates or finances income generating properties. Income generating properties are generally those properties which are owned for a specific intention to generate income out of it, a rental income out of it. Like you own a retail shop and you have subleased it to someone and you get rent from that property, that becomes a income generating property for you. These income generating properties could be a retail shop, commercial office space, nowadays warehouses as well. REIT almost work like a mutual fund where a collective amount of invested money get invested into some stock or different stocks, and similarly in REIT, these stocks are nothing but real estate properties. This fund or this amount of money gets invested into certain income generating property. So eventually you end up owning some fraction of space into some real estate property. Now, with limited amount of fund, you can become a owner of some real estate property. Now, how does REIT actually work? REIT generates a steady income stream for investors it, through the rental income where the money has been invested, and obviously there is a capital appreciation or the price appreciation into the property is there. REIT are publicly traded like stocks and it is being regulated by SEBI. So whenever you want to sell it, you can just sell it on that platform, on trading platform. It does not like where you need some certain amount of time to sell your actual real estate asset, and you need to pay brokerage, you have to wait for a long. REIT can be disposed easily, so it is highly liquid in terms of actual real estate property. So I told you earlier as well, REIT invests most of the money in some income generating properties. It could be your hotels, your office, retail centers, warehouses, cell towers, data centers, etc. So in India, we have three different REITs. Usually the REIT is a US concept initially launched in United States. Later it came to the other parts of world as well. In India, it has came in 2019 when Embassy has started its first REIT in India. Now there are three different REITs with the name Brookfield India Real Estate Trust, Mindspace Business Parks REIT, and Embassy Office Park REIT. Today we want to discuss about Embassy REIT because it is the first REIT which has been launched and it has the longest footprint in Indian subcontinent. If we talk about Embassy REIT has total portfolio of 42 million square feet. It's a huge area. And in 31st March 2022, financial updates or the annual statement published by Embassy, the occupancy level of these properties was 87%. Seems to be good as of now. And they hold their multiple assets in these different properties. And you can see the intended use of these properties are either office, IT, ITS, SEZ, non-SEZ, hotel, retail, convention centers, and there are multiple properties where money has been invested, and you can also see there is some solar park also in this one. If we see in terms of geography, then the 74% of the concentration of this REIT is in Bangalore. 10% in Mumbai, 9% in Pune, and 7% in NCR. In terms of construction status, 91% of this space is operational and 9% is an under construction. So, as and when you see the different videos on REIT, so there are many people who come and advise, oh, it's a very good thing, 9% or the huge space is there. Eventually, it will get converted into an operational property where you can also start getting money out of this space. Today, we are going to discuss on these points as well. So, before we move ahead, first we talk about the valuation of REIT. How the valuation is being done as per SEBI. A valuation of these properties need to be conducted on a biannual basis where these property are being valued by some professional agency and they keep on track whether the intended price or is there any significant change into a property price or not. COVID was a scenario where the property prices has been gone up and down. So to keep a check on the prices, SEBI has regulated that there has to be a professional agency who can monitor it. So to just make you understand what is asset value means, asset value means nothing but the valuation of that property. That means if there is a one tower, it costs you 1000 crores, then three towers would cost you around 3000 crores if all are in same micro location or it's the concentrated fund over there, but that's not the case here. The properties have been uh, situated in different geographies of India, has different characteristics, so a professional agency is there who check whether what is the valuation and they keep on, and these values are generally submitted to SEBI as well. Apart from that, there are other assets which company owns in terms of property, plant and equipment, and obviously there has been some liabilities. The major one are the debt which generally is being taken to complete the under construction properties or to make the repayments of the existing operational structures is always there. When you subtract your liabilities from your gross asset and other assets, you get your net asset value of the total fund. Now here the figures are in million here. So the total number of REIT units that is in market is 947 million. So the correct number is this. When you divide the total asset value by the number of units, you get your NAV per unit. That is rupees 393 and 90 paise. Now, what is the traded value as on date that we are uh, preparing this video? So the traded value is 404.95. It seems to be in correlation with the actual NAV. The intended purpose of today's discussion is to check upon this number, whether does this number makes a sense or not, and what is our personal opinion over this. It can be taken, different professional might have some different opinion, but I'm trying to give some rationale behind my own analysis. So before we jump into the analysis, first we understand few concepts regarding this valuation technique. First, we need to understand what is time value of money. If I say to you, shall I give you 100 rupees today or shall I give you 100 rupees a year after, which situation would you pick first? Obviously, you'll ask, give me today. Now change this case a little. Now I tell you, I'll give you 95 rupees today, or I can give you another option. I can pay you 100 rupees after 1 year. Now you'll give a thought. Okay, 95 today and 100 a year after, which makes a more profitable bet. So in terms of understanding a time value of money, 100 rupees a year after would have a net asset value of 95, might be considering there is a 5% discount rate which we are going to discuss here. Now discount rate is nothing, it is a rate which discounts the future value. Like I told you, 100 rupee after might have a value of 95 rupees as on today. So there is a certain discount rate which discounts that future value into present value. Now the calculation of discount rate is pretty important. To understand the calculation of discount rate, first we need to understand what is capital structure. You might have heard this term multiple times. But in terms of a real estate property, even in your personal expense as well, there there has been only two type of capital structure that you generally have. One, you have your own money in your pocket, that is saving, that is termed as an equity. And another form of capital structure that you borrow either from bank or from some financial institute, that is called debt. So generally, capital structure comprises of debt and equity together. Now, the weighted average of both will give you a weighted average cost of capital, which eventually becomes a discount rate, which is helped to discount the future cash flow streams of any given property, and the NPV of each stream and the summation of NPV of each streams give you the property value, which has been used earlier to estimate the NAV per unit. Now, our concentration first would be to understand what is debt. Debt is a loan that you take from a financial institute. It could be a institutional bank like SBI, HDFC, PNB, or it could be any NBFC like India Bulls or other NBFCs which are there in market. Now, equity is your privately held money. How it is being calculated? We generally check the reality stocks, how much equity they have earned through a kappa model. I'm not diving into it. We may discuss about these techniques on the later video. First, we shall be discussing about the present valuation versus the traded value of REIT as on date. Now, if we read through the financials or the valuation report that has been presented, we can see the discount rate adopted for the operational property is around 11.7%, and for under construction or proposed properties 13% of discount rate has been adopted, which seems to be on a very conservative side. Now, what how they have calculated it, they have considered around 50% of capital structure would come through a debt form and 50% of capital structure would be in an equity form. And for debt, they have assumed 8% or 9% of a rate of interest. On the equity side, they have considered 13 or 14% of the cost of equity, which seems to be very conservative. Now you'll think how this discount rate is affecting the NPV of the property. The simple logic would be the lower the discount rate would be, higher the valuation of property there would be. If you press or compress the discount rate, it will inflate your body, inflate your value of the property. If the discount rate would be high, your property value would be low. So I have presented few of the properties names and their adopted discount rates for over the different year, and you can see from last 2 years 11.7% has been considered for the operational properties for almost 90% of the property pool, which I think it's little conservative and it has to be little up. I shall be discussing about in my consideration what should be the apt WAC or discount rate that need to be adopted, and what is the finally corrected price of NAV that need to be assessed. That would be the end of this video. The second point that I want to continue with is the occupancy level. Occupancy level depicts the total number of proportionate floor is occupied by the tenants or rest remains the vacant. Basically, if you have 100 units, out of 100 units, if 90 units is occupied as on assessment date, the 90% becomes your occupancy level. Higher the occupancy level, more are the chances you are getting income from your property. Now, I have kept one more information here for all the properties. It represents the proportionate share in the entire valuation. It around roughly around to be it's 95%. Rest all investments are in hotels or in solar park. So I am looking at the 95% of the contributed properties here. So in terms of occupancy, the major one is Embassy Manyata, which is in Bangalore. If I see, there is a dip in occupancy from year 2020 to 2021, that is of 4.5%. That means 4.5% space has been vacated. Or from 2021 to 2022, there has been again a 4.7% in decrease. We can understand from the year 2020 to 2021 because it was a COVID scenario, but we were expecting a bounce back in year 2022, which is not there. So this point need to be keep in watch as and when new valuation report or new analysis come up by the embassy. If these things are not getting on an upward trend or continued to be getting on a downward side, it's not a good sign for this particular REIT. So you may take a snapshot of this particular picture and can assess upon this point. The other point that I want to discuss is the rent that you are receiving. There are two type of rent. One is in place rent, second one is market rent. Now imagine you have leased out your shop at 100 rupees per square feet per month, but in market the rent is 90 rupees. That means you are earning 10 rupees per square feet additionally in comparison to market. Now, if it would have been a case where you are earning 100 rupees of rent, but the market is suggesting 110, that means your property is trading on a lower rental value. So, in place rent is the rent on which your property is actually generating the money, and market rent suggests what should be the actual market rent of the property. If we see, I have categorized in place rent over here. You may pause the video and check for yourself that on many scenarios you may say our property are trading on a low prices, and the proportionate share is also mentioned, which may give you a picture that how these property trends are making an impact upon. Now there might be one thing that come up to your mind that, oh, it's okay if it's trading on a low value, that means once it'll get matched up with the market, you can anticipate more dividend or more income for this particular REIT portfolio. But wait a sec, you may check for a time for from year 2020 from to year 2022, because that is the only assessment period available for analysis. There hasn't been any substantial change in terms of in place rent in comparison to market rent. Now this puts a question on the asset management team or a project or the property management team. Are they managing these properties appropriately or not? The other few points that I want to discuss here is the capitalization rate. Capitalization rate is a ratio between your anticipated annual income from one property to the capital value of that particular property. This ratio is being used to convert a terminal cash flow into a terminal value. It is a value where we assume the property may get sold off down the line after 10 years or whatever the holding period that you are considering. For this case, the company has considered 10 years of holding period. The point here I want to make is for entire 3 years capitalization rate has been remained the same. However, we have seen up and down in the market. So if they think this has to be the same, it's okay. However, it is a known fact the market has seen up and down. The second point is higher stabilized occupancy rate. Now, what the stabilized occupancy mean? In terms of occupancy, we anticipate that sooner or later the property is going to achieve a stabilized occupancy. Now, let's assume a property right now is trading at a 50% of occupancy, but going ahead there might be a chance it may match up with the market. In market there are different research reports come up that you may refer to, from which you can estimate what is the occupancy level here. In this case, stabilized occupancy for like Bangalore region has been considered 97% for many properties, for 95% properties for other regions as well, which seems to be on a higher side. Now what impact it bring? It inflates the value. Higher the occupancy rate is, higher your valuation would be, and higher your NAV will go up. Now, the other point, you might have seen different videos where people are suggesting in this particular REIT, particular percentage of space is under development. It will bring up revenue in going ahead in near future, and it's a good point and it's a good symbol. But that's correct assumption, but you also need to keep in mind whether the proposed development is in line or not. For a case for Manyata, the proposed development was anticipated to be completed by financial year 2025 in the valuation report, which was presented in year 2020. In 2021, it has been shifted 1 year ahead for financial year 2026. And in valuation report of 2022, the same period has been now pushed to financial year 2031. Now this has been case for the entire portfolio. If you analyze the properties, You may see it has been pushed from year 2020's analysis versus years 2022 analysis. It has been pushed ahead. That means there would be a delay into it. Now, this also casts some doubts over the anticipated plans of the people who are managing these properties. So, here are few suggestions for Embassy. Firstly, you need to revamp your leasing strategies in order to bring your in-place rent in accordance with market trends. Second, the portfolio should not bind itself to the embassy property itself. You should look beyond it. If there are few properties which are not performing well, you should make some strategies to dispose that assets and to bring in some quality assets which might perform very well. The third and last point would be your portfolio has been concentrated more in Bangalore city. 74% share alone is with Bangalore. Now you need to consider a few other cities as well. You may consider Hyderabad for such a case where companies are moving up and it is also a flourishing market for real estate. Now the last part of our video is what is the price entry session. Before announcing it, I would like to tell you one thing. I have just considered few changes in terms of WAC only. No change has been considered on the terms of rent and occupancy level. So, as per my analysis, as per my understanding, the operational properties and under construction properties should have 100 to 150 basis point more discount rate considered to the adopted rates for this particular valuation. And for proposed projects, it should have an entirely new discount rate, which should be more than 250 to 300 basis points compared to which has been adopted by the company. So basis these points, the ideal entry price should be in range of INR 340 to 350 rupees per unit. I hope you liked my video. For any other topic you want to listen, just hit us in the comments below and don't forget to subscribe our channel. Thank you.